Very often do I get excited about a show, but I am very excited about this show today. We're going to be talking about leveraged ETFs. It's the new fad in town. These conversations have been popping up quite often with financial advisors and clients. A lot of clients will, in a meeting, hey, have you checked out, some symbol? It's paying 20%, 30%, 40%. It's never lost money.
Yeah.
Okay. And so let's just talk about it.
Well, I'm raising my hand.
Yeah.
Sure, shoot it to me.
Yeah.
I'll go check it out. What's going on?
What dividend company is paying, or what stock's paying 40%? So what's this? Let's just get into it. And I think you just said it perfectly. We are just as attracted to any good investment out there as anybody else. But when you start pulling back the layers of the onion, we start to see things that just don't either add up or become very, very scary. I will never sell a leveraged ETF. So if you're out there and you're a client and you're like, hey, buy this, I'm not going to do it. You can buy it on your own, but I'm not doing it. And there's lots of reasons why. So let's just jump into this. Let's talk about the new fad. What is a leveraged ETF? Let's just start there.
Well, all right. So here we go. So a leverage ETF really uses a financial derivative. So it's like a multiplier, but they base it off of an index. So the S&P,
the QQQ is a big one.
Or the NASDAQ, which is the NASDAQ
top 100. Yep.
So they really they're looking at these stocks, and if the S&P goes up 1%, they may give you a 3x. So your account would go up 3 times that amount.
Yes,
traditionally how they're working, but I know you've got
no. So the neat thing here is it's gambling. At the end of the day, it's like, hey, if it hits black, I'm going to get X times my value. If it hits red, I'll get X plus times my value. If it doesn't hit either, you can lose a boatload of money, sometimes on a multiplier as well. So if I hit right, and the market goes up 1% today, I could make 3 to 4% today. Just today. Market goes up 2%, I could make 6% just today. Now, if the flip side happens and the market goes down 1% or 0.5% or whatever, you multiply that on the down. So a lot of these, leveraged ETFs are promoting like, hey, we're paying 13, 15, 20, 30. There's some that are promoting 40% income in a year, which, by the way, who's not attracted to that? Like, sign me up. But the reality is they are promoted as an income vehicle. And I love this. If it sounds like income, smells like income, and pays like income, but it's backed by profit, it's not income. These are 100% profit vehicles. If you were to dig into any of the companies, and we're going to pick on a couple, but if you were to dig into them, you're going to find that the lion's share of their holdings don't even pay dividends.
No.
So you have these companies that are literally using the word dividend because they might have a few holdings in there that pay a dividend, but the vast majority don't, and they're just leveraging some index or some companies and paying out a portion of when they have profit. But most of the time, they might just be paying out principal,
right?
Which is the worst type of thing.
Yeah, it's kind of a little bait and switch action that's happening there,
which is really, really scary. All right, so there's dividends versus distributions.
Yep.
Okay.
So we love dividends. We've covered this.
No, we don't ever talk about
ad nauseum almost here, but we're going to keep beating that drum. But so dividends are paid from profits of the company, not appreciation of their stock price.
Hopefully.
So it's really, but it's true cash that's being generated by that company. They have profit, and then they're going to declare a certain portion of that profit that they've made to pay a dividend to you, typically on a quarterly basis. However, the leverage ETFs are a little different,
which we kind of already explained.
Yep.
So if they're placing their bets and it's a more conservative leveraged ETF, it might be a 1.5 times or 2 times, because there are some that are like 3 to 4 times. So if it's depending on the risk that's involved, the volatility that's involved, they might pay weekly, because that's the big thing I hear. It's like, oh, well, they pay weekly. I can make 6% a week, or 3% a week, whatever the number is. And I'm like, can you? Like, really? Like, why wouldn't I be doing this, if it was that good?
That's right.
Because we're gonna dig in a little bit later on the performance side of things, and really see how good these things are, and why they look the way they do. But a leverage payout is just a distribution. Sometimes they're going to pay out profit. A lot of times there's going to pay out principal, because they can't guarantee. And by the way, you want to talk about, on the dividend side, they're not guaranteed. But we can look at history,
Correct.
long, like century history,
Yes. Like,
and go, hey, these stocks over here have literally not missed a payment in 100 years. Is it guaranteed? No. Have they missed a payment in 100 years? No. Are they guaranteed? Nope.
Nope. Because it could change.
But they've paid for
a lot of history here.
decades and decades and decades. Yep. On the leveraged ETF side, they were really created within the last 15 years. Okay, there's one leveraged ETF that we're going to talk about in a minute. That's been around since 2013, 2014. That's the longest standing history. It's not very rosy. Shocked that they're still around, but most of them have just been around since really 2020 or later. Most of them have started in 22, 23. Yeah.
Which conveniently was right after 21, which was the down year.
The last dip. So, because once we have a dip, they'll all reset again.
That's right.
Okay.
They'll just blow them up and start over.
So what's the catch? What's the catch with a leveraged ETF? We're kind of beating around the bush a little bit. We're kind of talking a little bit, but like, why should you be scared? Like, is this a bait and switch? Like, what's the deal?
I feel like it's a bait and switch, and we'll take this kind of analogy that we were talking about earlier. A leverage ETF is like selling pieces of your house every week to pay your rent.
Mm-hmm.
Like, you're just slowly taking principal or your asset. If it's not growing, you're just dispersing that as income and saying that you're making money on it. But at some point, you're going to run out of capital to give yourself.
Well, one of the underlining themes that you're going to see here is that leveraged ETFs only work when the market's going straight up. So when there's volatility in the market, like if you have a 2020, a 2022, where the markets were very volatile. 22, the market was just basically straight down. 23, 24, markets were straight up. And that's why you're going to see most of the long-term performance in leveraged ETFs has started back in 23, 23 to present, because there's been no volatility, and you're going to find a hard time discovering leveraged ETFs that go beyond that. Mm-hmm. Because when it's bad, it's really bad. And when it's good, it's good.
Yep.
So the catch is there's just no long-term performance. So when the market's volatile, they pay out portions of their home. They pay out portions of your principal. They're not making any money. And you're basically taking your own asset and giving it to yourself in return and boasting, like, oh, I made 30%. You spent 30% of your own money.
Right.
You didn't make a dime. You actually lost assets. So the catch here is it's not real income. It's fake. It's not real.
Right.
And which is, in my opinion, so deceptive that, these companies out here, they're beating their chest. We've only made X return. We're issuing this much money a week, when they flat out know when the market turns upside down, they're going to lose their shirt. And I know a lot of advisors that are wanting to go all in on this stuff, and they're going to lose so much of their business, and they're going to lose so much trust in clients when things turn. It's a reality. It's going to happen.
It's shiny, and
it is very
like that.
shiny,
and especially the big yields that they're talking about.
Well, these weekly yields. Yes. I think that's the biggest draw. Is like, we're talking about a 6% annual yield plus growth, but a 6% target. Like, hey, let's go get this, and they're like 6%. Ha! Yeah, I can make 2% a week. Or whatever they're saying, 1% a week, 4% a month. And I'm like, are you really going to make 4% a month? Like, where's that? If it was that easy, wouldn't everybody be? Why wouldn't they shut down everything else?
Right.
And we would all do this. Why? Who wouldn't want 40% a year? I know some very wealthy people that wouldn't touch a leveraged ETF out there.
Yeah.
Like Warren Buffett's not talking about it.
No, definitely not on that side.
Yeah, none. All right, so let's talk. Yeah. I want to dig into a little bit of like the biggest dangers. Okay, so first is volatility decay. So we've kind of beat around the bush on this one a little bit, kind of talked in circles around it. But the reality is, more often than not, your income that you're receiving is going to be a portion of your principal, more often than not.
Right.
Okay. What else? What's another one?
Well, you've just got, I mean, over the history, which you said, we'll get into it, but over the history, it just doesn't perform like the index that it's actually modeling itself after, because there's no short term, or everything's short term with these things. There's no long term history. They're not able to perform, and with it just being short term holdings, like you can't really dig into it.
Another one is misleading yield. They promote this 15, 20. I mean, there's one that we'll talk about. Literally, it's marketed as a 40% yield. It's not even real. Okay. Another one would be long-term underperformance. This one's the most disheartening of how much volatility and how bad their long-term performance is, of why we can sit here and say, you're just getting your money back. No, you are getting some return. Don't get me wrong. Like some of these may be paying 20% yield, 30% yield. But they're really only paying, depending on the year, it might be 10% earnings, it might be 6% earnings, it might be 20% earnings in some years, 30% earnings. And then the next year you might be getting 30%, but it's 100% principal.
Mm-hmm.
So the reality is, and we'll see when we talk about some of their actual long-term performance of how bad they are long-term. Principal risk disguised as income. Like this is probably the biggest one that you're going to see when we start talking about performance is they're like income, principal. Like it's not really generated income. It's profit. It's a hope for profit that will tell you is income.
That's right. And one for me, I always tell my clients, if you don't understand something, you probably shouldn't invest in it. Mm-hmm. And these things are super like opaque, complex. They're difficult to even explain how they're getting return. And, we haven't even talked about, there's, sometimes options tradings that's going on here, these covered calls and stuff that are happening in the background to generate some of this income as well. And whenever it starts getting that complicated to where you can't easily explain it and understand it, I'm always like, I'm out. I'm backing off.
Yep.
Especially whenever you can't explain it to the person who's hiring you to invest their money and they want to trust you. And if it starts getting that complicated, we probably all need to back off.
Two more. One real quick, we'll breeze over. It's highly tax inefficient. Most of this is day trading. You're in, you're out. It's all short term. It's the worst tax efficiency in trading that you can get. And probably the most important danger, frustration for me personally is that is a false comparison to a dividend stock. And an ETF, you want to get my BS meter going crazy, you want to get my blood pressure going up, have somebody tell me, why aren't you buying those dividend ETFs that are making 30% a year? This is not a dividend stock. Like this is, if you look at their underlying holdings, let's just say, I mean, some of them, it's just one. It's the QQQ that they're leveraging. Some of them might be a bushel of many different things. Most of the holdings in there, and I'd venture to say 95 to 99% do not pay dividends. Yet they're compared to dividend stocks. That is 100% wrong. False.
Yeah.
Not true. Busted.
Yeah. A dividend is a share of a company's profit. This is not a share of an ETF's profit.
At all. Okay. So how long have leveraged ETFs been around? Okay, so I've already told you the oldest one that we could find was launched in 2013. It's QYLD. Okay, QYLD has its total return. Ready for this? This is how bad they're long. This is the oldest one we could find. Okay, most of them were started in 2020, with the vast majority started in 2022. QYLD. It's based on the QQQ. The QQQ, since its inception, since 2014, is up 400%. The total return of the QYLED is 60%, which is underperformed on a year-by-year basis by about 80%.
Good grief.
It's underperformed by about 80% of its benchmark. That is insane. Like, and yet they're boasting huge returns, that they're making, all this great income, but it's volatility is what's eating it alive.
Mm-hmm.
It's having to pay these huge yields. It's based on an index that's made 400%. That means you put in $100,000, it should be $400,000. You put in $100,000 into this leveraged ETF that's saying, hey, we're making X% rate of return a year. We're paying out weekly or monthly. And yet it's only 160,000 20 years later when the index has doubled 4 times over.
I'm good. Just go buy the fund. Go buy the QQQ.
Seriously. And we've had shows that talk about dividends versus the QQQ.
Right. So
now we're talking about specific investments that are based on the QQQ that boast huge rates of return that are underperforming it by 80%.
Awful.
Horrible. And here's the crazy thing. The QQQ has only gone down 3 times in the past 25 years.
Which is like, it should not be doing
You know why, though? It's because they're leveraging it on a daily basis.
So they're locking in those losses.
Those losses. Because how many times you see the NASDAQ in a day go down 1% to 2%? And then in a day go up 1% to 2%.
Sure.
Well, the losses hurt a whole lot more than the gains help you.
Yes, because it takes way more to
get back.
Yeah.
So if you lose 2% in a day, you got to get 4% the next just to break even.
Right.
The math is way against you, and that's why they're underperforming. If this logic worked well, they should be up 800%.
Right. They should be killing it.
But they're not.
Nope.
Okay. When you look at these other ones, like you've got JEPI, TSLY, OARK, all of these been out somewhere between 2022. One of them was out in 2020. Most of them are after 22, when there's been no volatility, no negative years in the QQQ. And yet the TSLY, in its first year, it boasts of a 40% yield. Fact check it. 40% yield. Its first year, it lost 60%.
Because it's probably solely tied to Tesla, right?
60% loss in its first year when it's promising and promoting a 40% yield, okay, on a stock that doesn't pay a dividend.
And then the ARK.
Why? Another thing I don't understand is why are we only seeing positive headlines on these? You know why? Because this performance is only like 6 to 18 months old.
That's it. They're new. I mean, it's been only in the past really, you said it, 6 to 18 months that they've really had a hard push on these. The market continues to go up. They're thriving in this environment for the short term. But the second that it flips, there's going to be a whole lot of hurt that can come with that.
Well, and here's my take on why there's only positive news. Is because the graveyard is vast. What does that mean? That means the moment that these ETFs start doing poorly, they put them in the grave. They defunct the fund, they create a new fund, and they start all over. So they don't have to boast bad performance. This is I mean, why is only one that goes back to 2014 that's been able to keep its head above water? Vast majority of them, they're so far underwater that they just dissolve the fund and then they start a brand new one because it's easy to raise capital.
And we've talked in other shows where when you're starting to talk about the transaction costs, that's where these big wirehouses, that's where they're making their money. So if they can get
just flip it all
more
around.
Commissions moving over, transactions, they're making all those margins and spreads. So they're making their money, but you, the investor, are the one sitting there left holding the bag.
I mean, these are not real. Don't buy into the hype. It's a fad. It's the vast majority. Like I would ask you to Google search, go to chat. How many of these leveraged ETFs have gone defunct? Have folded, closed their doors? And I bet you it's a 2 to 1 for every new ETF that's made. There's probably 2 that have been defunct. It's this bad. It's attractive. It's a trap. I would love to
They're
get
like
into
the
it.
shiniest of shiny objects in our world.
But it's a terrible investment.
Yeah.
Like I might be smiling, but inside I'm like angry because this should be false advertising.
Yeah.
you know, because they're not a 30% yield. It's not a 50, it's not a yield at all.
It's not any type.
They're promising profit.
It's return of growth.
Yeah, return of
or principal.
Yeah, to a large degree. Okay, any last words besides subscribe to our show?
No, I think you just have to know that these things are built for excitement, to get you to move into this fund, try to get some of the income, but it is not set up for long term. And you have to be extremely careful if you're starting to dip your toe into this water.
If somebody were to, you know, call my cell phone, I have a fun message on it right now, but I used to have like a tagline I've been using for a very long time: smart decisions determine the quality of your life. And, you know, when we do shows about making smart decisions, it's always about doing your research, putting your best foot forward, and digging into the details that matter. If you took the time to dig into a leveraged ETF, it wouldn't take you long. Right. You'd be completely turned off. You know, like you read a headline, you're like, oh, clickbait.
Yep.
Here, they put all this flashy stuff up where it looks really good, but the reality is they're terrible investments that promise a lot, that deliver almost nothing. Mm-hmm. So I would say, when in doubt, don't. This is a big doubt. I wouldn't touch a leveraged ETF. Hope you enjoyed today. This was a lot of fun. My blood pressure has been all over the place today, but God bless, and I hope you paid attention today and subscribed to the show.